So we've mentioned the Federal Reserve Bank a bunch of times so far in this section of the module. So now let's spend a little time and explore what the Federal Reserve System is. So the Federal Reserve System is made up of three different kinds of main structural entities. The Board of Governors sit in Washington, D.C. They're appointed basically by the president and confirmed by Senate, just like federal judges are, other kind of federal appointed positions. It's a similar process, and they basically serve 14-year terms, and there's seven board of governor members. So they're in there for quite a long time. 14 years is, of course, longer than a congressperson, longer than a senator, not as long as a Supreme Court justice who has kind of life appointment. But it is a very long time that the governors are kind of expected to be on the board, and they're obviously in D.C. They're in the headquarters of our federal government, and then there are also Federal Reserve Bank branches. There are 12 regional Federal Reserve banks, and they're typically located in the major cities of each kind of part of the country. Like, there's one in San Francisco, there's one in St. Louis. The biggest one is the Federal Reserve Bank in New York, which is, the one with extra responsibilities, which we're going to talk about in a second. But I guess the key takeaway is that each region kind of has their own Federal Reserve Bank. Like there's one in Chicago in the South, there's one in Atlanta, there's another one in Richmond, Virginia. So, there's 12 of these banks scattered around the country, and each bank is kind of tasked with uh, regulating and controlling and kind of dealing with the banks in its particular region. Okay, so the Federal Reserve you can think of as the bank that all the other banks use. Okay, so they sit kind of above all the banks that we deal with. They sit above them as basically where those banks, when they need loans, when they need to keep deposits somewhere, the Federal Reserve System is their bank. And so each of these regional banks is kind of responsible for whatever banks are in its particular region. Technically, each of these branches of the Federal Reserve banking system are independent, but really they all work together to implement the policies that kind of the Board of Governors and the Federal Open Market Committee, which we're going to talk about in a second, kind of whatever policies are decided, the branches will also kind of work together to implement those policies. And then finally, as I just mentioned, there's this Federal Open Market Committee. And so basically, it's composed of some members from the Board of Governors and then some uh, Federal Reserve branch bank presidents. They come together and they basically uh, are responsible for setting the basically the main tool that the Federal Reserve government, or sorry, the Federal Reserve System has to implement its policies through open market operations, which we're going to talk about. So the Federal Open Market Committee is going to set those policies, and those policies are like kind of the main. Uh, it's what all investors and kind of business people. It's the main policy. The decisions of the Federal Open Market Committee are the important ones. Are you know maybe the in the hierarchy the most important one. There are other important decisions that the Federal Reserve System makes, but this is the one that kind of makes the headlines when they set the interest rates. So this Federal Open Market Committee is responsible for making the kind of key decisions of what the Federal Reserve is going to do, how they're going to intervene in the kind of the setting of interest rates through doing things in the open market. And so um, it's a pretty important committee in this system. So the Federal Reserve System has a couple of functions. The most important one, why they're kind of looked at, and people try to like decipher like exactly when the chairman of the Federal Reserve System makes a statement or the banks make a statement, people are trying to read between the lines and exactly under and try to find all the nuances because uh, they're setting interest rates. Okay, they're controlling the money supply and affecting the setting of interest rates, which, as we've discussed, affects ripples through essentially the entire economy. So, what the Federal Reserve System and its leaders are going to do is very hotly contested and followed, and people want to try to have some edge in understanding kind of their next move. Because if you can do that, and kind of predict that well, then you can kind of prepare yourself and invest or make certain decisions accordingly. The Federal Reserve System also regulates banks. There's a bunch of different federal agencies that regulate banks. The Fed is one of them, um, and really, as I mentioned, they're kind of the bank to the banks. So if some bank was in trouble and needed a loan, then the Federal Reserve System would step up and lend to that bank. So they make loans to banks, because they do this, they have some say in the regulation of those banks. Part of their responsibility is to provide oversight to the basically at the national level to the large banks, and also kind of think about the systemic risks to the banking system as a whole, because really the Federal Reserve is backstopping all of that. So their job is to kind of see where the really big risks are that could take down the whole system and try to implement policy to prevent that from happening. The Federal Reserve also acts as a clearinghouse. They provide basically financial services like clearing checks, facilitating electronic payments. If some foreign governments that invest in U.S. Treasuries, for example, will have accounts with the Federal Reserve System to kind of uh, hold their deposits. So, like if the government of Saudi Arabia wants to buy U.S. Treasuries, instead of taking actual possession of them, they may just open an account with the Fed and hold those holdings with the Fed. So it's like they kind of act as a depository for foreign governments and institutions too. So they provide a bunch of different financial services, um, and so that's another one of their functions. And then finally, how does the Federal Reserve System implement its policy decisions? The major one is open market operations. The branch in New York is the one that actually conducts all the buying and selling. So basically, the Federal Reserve will go onto the market, the open market, and either create supply or demand for U.S. Treasuries and U.S. kind of government debt. It also intervenes in like the mortgage-backed security market, which we'll talk about in the section on real estate finance. So it intervenes in these markets by directly creating demand, which is probably the most common one, where they will buy government bonds in the open market. By creating this demand, um, they're adding. So let's be clear about the terminology. They are providing capital to the market by acting as a buyer. So they're an investor essentially. They're going to basically create money and buy bonds, and the more demand there is for a bond, the lower the interest rate is going to be. Okay, so by going to the market and purchasing bonds, the Federal Reserve can lower interest rates essentially. That's going to be kind of the effect of them going out and creating demand for US Treasuries. They're going to basically create money and then buy the bonds in the market with that money and basically put that money into the banking sector. Okay, so um, by increasing the supply of money, by doing these open market operations, when they buy bonds, they're essentially uh, buying a bond and then injecting money into the system because they're trading this newly created money for the bond, and so that money now exists in the banking sector, or in the economy, because the government essentially will eventually get that money because it's borrowing and it's going to spend that money on its projects, all defense, social security, whatever expenditures it has. Um, it can also uh, affect interest rates by setting the discount rate uh, at the discount window. So, as I mentioned, if a bank needs a loan, it can directly borrow from the Fed. And so, this discount window is essentially the rate at which uh, the Fed will lend to its kind of member banks. So, it can basically incentivize the banks to borrow by lowering that rate. It's like the banks are much more eager to borrow if that discount window rate is, let's say, a tenth of a percent. But if the Fed raises that to 2%, then the banks are like, no, I don't want to borrow 2%. I'm happy to borrow at 1%. I'm very happy to borrow because that's essentially free money, and I can borrow from the Fed at 0.1% and then lend it to someone getting a car loan at 7% and kind of make a big spread on that because I'm lending at 7, I'm borrowing for whatever it is, a tenth of a percent. So I'm making 6.9% spread, right? But if the Fed raised the rate to 6% and they can only lend it out for 7, then they're not making as much and they may be reluctant to do so. So setting the discount rate uh, at the discount window is going to affect how much money is going to trickle into the banking system again. And then the third major lever they have is setting bank reserve requirements. So basically, when a bank takes your money, you put deposits. It's not just holding that money; it's going to re-lend to a someone who's looking for a loan. Okay, so they're essentially, they may pay you 1% interest on your savings and then lend it. So this is how much they pay you, and then they may lend it out at 4%. So they're going to pay you 1%. They're going to collect 4% from the borrower, and they're going to pocket 3% as their spread. This is their profit. Okay. So what the Federal Reserve can do is basically, and let's say you put $100. So depending on what the reserve requirements are, the Fed may be like, okay, you can of this 100, you're allowed to lend $90 of it, and you have to keep $10. So 90% of it you can lend, and you have to reserve 10% of it. Okay. Uh, if they change the reserve requirements, let's say you have to reserve 20% instead of 10, so they can no longer lend $90 out; they can only lend $80 out. Okay, so that will put less supply of money into the economy. That will have the effect of raising interest rates because there's less money sloshing around to be lent out by the banks. Because now they have to keep more instead of 10%. They have to keep 20%. They have to keep $20 rather than 10 just sitting around. Okay, so by changing the reserve requirements, they can kind of affect the supply of money that's available through the banks. So these are their main ways that they can kind of affect the setting of interest rates. Okay, and then finally, just to give you a little bit of a better sense of what's going on with the Federal Reserve, this is a graph of total assets of the Federal Reserve. Okay, so this is when they go out to the open market and buy U.S. Treasuries or U.S. mortgage, or sorry, buy mortgage bonds. These are all accumulating on the balance sheet of what the Federal Reserve System owns. Okay, what they're holding. Okay, because when they go out to the open market and buy stuff, it's going to show up on their balance sheet. Okay, so this is basically the total amount of stuff that they own. Okay, so you can see uh, back in 2008, so this is during the financial crisis, they had a total balance sheet size, their total assets was 872 billion. Okay, um, now the total GDP of the country is around 25 trillion. Okay, so this is less than 1/25th of the total size of the US economy. Okay, so there is something big that happened here. And if we go back in time, this line is not gonna. It's been increasing over decades, but something very important happened during the financial crisis, where you see this really big increase from. It's going from around 900 billion, and it jumps up very quickly to 2 trillion. Okay, so what happened here? It was decided during the Obama administration that the Federal Reserve could basically monetize debt, meaning it could just wholly create new money and just inject it into the banking system and uh, just basically print a lot of new money. Okay, this was people were reluctant to do this before. It was kind of a slow creep, but during the great financial crisis, it was thought that to avoid a total failure of the banking system, the Federal Reserve just had to go in and just bail all the banks out, and whatever crappy loans they had on their balance sheet, they could just basically give it to the Fed, and the Fed would just create new money and give it to the banks and kind of bail them out. So this was done here. It was like kind of the first wound that was opened, and you can see here that after this big jump, okay, nothing too drastic happens. Yes, during 2013-14, it does grow quite a bit, um, because now it's acceptable for the Fed to basically monetize debt. Okay, just be able to just create new money when needed. The government can continue to finance its deficits, meaning what it's spending versus what it's collecting in taxes. It's the taxes are never enough, so the government has to borrow. So this could just continue on and on and on, and the Fed could basically uh, finance that by creating new money. So this is kind of a now accepted thing to do. And then what happened here? This is in March of 2020. Uh, the government had massive spending for COVID, and it was basically new. The Fed basically intervened, said, okay, the government needs $3 trillion for stimulus. We will go ahead and just print the money and just make that available to the government. And so that's kind of what happened here. So you see this massive spike here, and it's kind of been continuing on with all the stimulus and all the extra deficit spending that's gone on since COVID. Uh, Now you can see that the total balance sheet of the Fed is close to 9 trillion at the peak. Okay, so again, I told you the total size of the American economy, meaning like uh, if you just took the total goods and services that are transacted in America, it's 25 trillion. Um, in 2008, we weren't even at 1 trillion. Now we're at 9 trillion. Okay. So it's been a massive, massive, massive increase. And so the Fed must have realized that, hey, this is like not sustainable. We got to do something. They implemented some system of like, hey, we got to reduce the size of our balance sheet by not basically like not buying as many securities and kind of selling the ones we have. So it's been trying to do that, but you can see there's a huge way to go to get back to 2008. It's probably not going to happen. There will probably be some other panic or financial crisis, and the Fed is just going to print more money. And this will likely continue until the system is not sustainable, unfortunately. We don't have the political will or the desire to change the system. And um, yeah, unless there's a really strong change in leadership and vision, this system will eventually become unsustainable. But history is full of surprises and people waking up and making necessary changes. So hopefully, we as a government and society kind of wake up to financial reality and fix the problems that have kind of started over the last 20, 30 years, you could say. Okay, and then one more graph to show, just to kind of tie this together with that graph we saw of the Fed's balance sheet growing over time. Uh, this graph here shows who is the holder of U.S. Treasuries, and it kind of breaks out domestic and foreign. Okay, so these are all the people that are financing our government who have lent money to our federal government to pay for our Department of Defense, Social Security, Medicare, uh, all the federal government expenditures. What we haven't been able to pay for with taxes, we've had to borrow. And here are all the people that have borrowed, or sorry, have lent to the federal government. You can see the largest lender is the Federal Reserve System. So this $6 trillion is just money that the Federal Reserve System has printed and created. Okay. Again, this used to be 800 or 900 billion before 2008, but it's ballooned to 6 trillion. Okay. So that's a huge amount of new money that's kind of been created by the Federal Reserve System. And then you see mutual funds, local governments, pension funds, um, and then we have foreign holders. Everyone talks about how China and Japan own so much debt. You can see their total holdings in comparison to how much our Federal Reserve System holds. It's the Federal Reserve System is much more. Okay, so you can see that basically the Federal Reserve is the single largest lender by far to our federal government, and it's not like they're an entity that's creating value. They are just creating money. They control the money supply. So, this hopefully ties together what we just saw with, who's holding all the public debt that we have, at least at the federal level, because then this doesn't include how much states borrow, how much local governments borrow, etc. This is just our federal government debt.